Picture this. $11,000 just landed in your account. You didn't work a single hour for it. You didn't sell a single share. That's what happens when you own stocks that pay you monthly instead of just 4 times a year like almost everything else. Spread $1 million across the 25 stocks in this video, and depending on how you weight them, you could be looking at anywhere from $5,000 to $20,000 landing in your account every single month. And here's the catch. Some of these dividend stocks are built to protect your money, and some are built purely to chase yield, and once you can tell them apart, you'll know exactly where to put your first dollar. Quick question before we start. Why do most companies pay quarterly, but a small group pays monthly? It comes down to the type of business. Most monthly dividend payers fall into 3 buckets, and understanding these 3 buckets is honestly 90% of what you need to know before investing in any of them. Bucket 1. REITs, or Real Estate Investment Trusts. These are companies that own real estate shopping centers, apartments, medical buildings, and by law, they must pay out at least 90% of their taxable income to shareholders. Many choose to do that monthly, matching the rent checks they collect from tenants. Bucket 2. BDCs, or Business Development Companies. These lend money to small and mid-sized businesses that banks often won't touch, collecting interest income and passing most of it straight through to you, frequently on a monthly schedule. Bucket 3. Mortgage REITs. These don't own physical buildings, they own mortgages and mortgage-backed securities, essentially acting like a bank that borrows cheap and lends at a spread. This category tends to have the highest yields on this entire list, and also the highest risk. We're covering all 25 in that order: BDCs first, then REITs, then mortgage REITs, building from moderate risk toward genuinely high risk. One more thing before we start. Quick disclaimer. I'm not a licensed financial advisor. This isn't personalized advice, and every yield mentioned here is a snapshot that will move over time. Always do your own research before investing. Now, the 25 stocks. Stock number 1. Main Street Capital, ticker EMAN. Main Street Capital is widely considered the gold standard of the BDC world, and it's a genuinely good place for a complete beginner to start understanding this category. The company provides debt and equity capital to what's called the lower middle market established businesses with real revenue, not startups supporting buyouts, growth financing, and acquisitions. What sets Main Street apart is its track record of dividend stability and modest, steady growth, rather than the boom and bust payout swings you'll see later on this list. It also periodically pays supplemental dividends on top of its regular monthly payout when portfolio performance is strong, functioning almost like a bonus. The yield here typically sits in around 5 to 6% or 7%, genuinely modest by BDC standards. And that's precisely the point. Main Street trades at a premium to its peers because investors are willing to pay more for reliability. If you're brand new to BDCs, this is the name most experienced income investors would point you toward first. Invest $25,000 in Main at roughly a 6% yield, and you're looking at approximately $125 landing in your account every single month. Stock number 2. Gladstone Capital, ticker GLAD. Gladstone Capital is a BDC focused on lower middle market lending, senior loans, subordinated debt, and some equity to established American businesses. Like Main Street, it's part of a small family of Gladstone-branded funds, though Gladstone Capital specifically leans toward debt investing rather than buyouts. The current yield runs around 9 to 10%, noticeably higher than Main Street, reflecting a real trade-off. Gladstone's portfolio is predominantly floating rate, meaning its income rises and falls with prevailing interest rates. When rates were higher, that boosted income significantly. As rates have leveled off, that tailwind has faded somewhat, though the company has offset it by steadily growing its total loan book. Net investment income has generally covered the distribution with some cushion, which matters. A dividend that's barely covered by actual earnings is a dividend at real risk of being cut. Worth knowing for a beginner. Gladstone did trim its monthly payout in recent memory, a reminder that even established BDCs aren't immune to adjustments when the lending environment shifts. Invest $15,000 in GLAD at roughly a 9.5% yield, and you're looking at approximately $119 landing in your account every single month. Stock number 3. Gladstone Investment, ticker GAIN. Gladstone Investment is Gladstone Capital's sibling fund, but with a meaningfully different strategy. Instead of primarily lending, it focuses heavily on buyouts, taking equity stakes in the lower middle market businesses it invests in alongside debt financing. That equity exposure means Gladstone Investment's fortunes are tied more directly to how well its portfolio companies actually perform and grow, not just whether they can service a loan. The base monthly dividend yield sits meaningfully lower than its sibling fund, generally in the 5 to 6% range, but Gladstone Investment has a history of paying special, supplemental dividends on top of the regular monthly payout when it successfully exits an investment at a profit. Those special payouts aren't guaranteed or predictable, so don't build them into your expected income, but they're a real, recurring feature of how this fund has operated historically. This is a genuinely different risk profile than a pure lending BDC, more upside potential tied to business performance, but also more variability. Invest $10,000 in GAIN at roughly a 5.5% yield, and you're looking at approximately $46 landing in your account every single month. Stock number 4. Prospect Capital, ticker PSEC. Prospect Capital is one of the largest and oldest BDCs on the market, with a sprawling, diversified portfolio spanning senior debt, mezzanine financing, and even some direct equity and real estate holdings. Its sheer size and diversification is often framed as a strength, spreading risk across hundreds of positions rather than concentrating it. Here's the honest part beginners need to hear. Prospect Capital has cut its dividend multiple times over the years, and its yield, which can run into the over 10%, reflects a market that's genuinely skeptical about long-term payout stability, not just generous income. The stock is also traded at a persistent discount to its net asset value for extended periods. Another signal the market isn't fully trusting management's valuations or capital allocation decisions. This doesn't mean Prospect Capital is a bad company. It means it's a name that requires real due diligence, not a set-it-and-forget-it income holding. High yield here is compensating you for genuine, demonstrated risk. Invest $8,000 in PSEC at roughly a 11% yield, and you're looking at approximately $73 landing in your account every single month. Stock number 5. Pennant Park Floating Rate Capital, ticker PFLT. Pennant Park Floating Rate Capital does exactly what its name suggests. It invests primarily in first lien floating rate loans to middle market companies. Being floating rate means its income adjusts with interest rates, which was a major tailwind during recent higher rate periods. The current yield sits in a high double-digit range, among the highest on this entire list, which is a significant signal worth pausing on. PFLT's payout ratio, how much of actual earnings gets paid out as dividends, has run above 100% in recent periods, meaning the fund has, at times, paid out more than it earned. That's not automatically catastrophic for a BDC, since net asset value and realized gains factor in too, but it's a genuine yellow flag that a beginner should understand rather than just chase the headline yield number. PFLT also pays a base dividend plus a smaller supplemental amount most months, which has been adjusted downward in the recent past. This is a name where the yield looks exciting on a screener, but deserves real scrutiny before committing meaningful money. Invest $5,000 in PFLT at roughly a 15% yield, and you're looking at approximately $62 landing in your account every single month. Stock number 6. Pennant Park Investment, ticker PNNT. Pennant Park Investment is the sibling fund to PFLT, investing across a broader mix of the capital structure, senior loans, subordinated debt, and some equity co-investments in similar middle-market companies. Because it takes on more subordinated and equity risk than its floating rate sibling, it sits further out on the risk spectrum. The yield here is genuinely extreme, often sitting near 20 to 30% depending on where the stock price trades relative to its dividend. When you see a yield that high, here's the honest beginner lesson. The market is pricing in real uncertainty about whether that dividend rate is sustainable. A stock yielding this much isn't a secret the rest of the market missed. It's the market openly telling you it doesn't fully trust the current payout to continue unchanged. PNNT's payout ratio has run dramatically above 100% of earnings in some periods. This is not a beginner's core holding. If you're drawn to this yield, treat it as a small, speculative position you could genuinely afford to see cut, not income you're depending on. Invest $3,000 in PNNT at roughly a 25% yield, and you're looking at approximately $62 landing in your account every single month. Stock number 7. Horizon Technology Finance, ticker HRZN. Horizon Technology Finance takes a more specialized approach than most names on this list. It provides venture debt specifically to growth stage technology, life sciences, and healthcare companies, often ones backed by venture capital that haven't yet reached profitability. That's a genuinely different risk profile than lending to an established, cash-flowing lower middle market business. Because these borrowers are earlier stage and higher risk by nature, Horizon often structures deals with warrants, the right to buy equity later at a set price, giving it some upside participation if a portfolio company eventually succeeds or gets acquired. When that works, it can meaningfully boost returns. When a portfolio company fails instead, that debt can become difficult to recover. One important current fact worth knowing: Horizon Technology Finance has been involved in merger activity with another BDC in this space recently, which is exactly the kind of structural change that can affect a monthly dividend payer's future payout. A good reminder to check a company's latest news before investing, not just its historical yield. Invest $12,000 in HRZN at roughly a 11% yield, and you're looking at approximately $110 landing in your account every single month.
No intent. No.
Stock number 8. Saratoga Investment Corp., ticker SAR. Saratoga Investment Corp. is a BDC investing across senior and mezzanine debt, along with some equity, in lower middle market businesses. It's managed by an experienced team with a long track record specifically in this space, and it's grown its assets under management steadily over the years through a mix of debt issuance and equity raises. Recent performance is worth being candid about. Net investment income has softened somewhat as portfolio yields compressed, and net asset value per share has seen some erosion from portfolio markdowns in recent quarters. To its credit, Saratoga has maintained its distribution level even as coverage from current income has gotten tighter, meaning the fund is drawing on a slightly thinner cushion than it was previously. Revius lead E. The yield here typically runs in the around 8 to 11%. This is a name that rewards actually reading the quarterly earnings reports rather than just tracking the yield number, since the underlying portfolio health has been shifting. Invest $20,000 in SAR at roughly a 9.5% yield, and you're looking at approximately $158 landing in your account every single month. Stock number 9. Capital Southwest, ticker CSWC. Capital Southwest is a lower middle market BDC based in Texas, primarily providing first-line debt financing alongside some equity co-investments to established businesses. It's generally regarded as one of the more conservatively run, higher quality names in the BDC space, with a strong historical track record of credit performance. The company pays a base monthly dividend and has periodically supplemented it with additional payouts tied to strong portfolio performance, similar to the pattern we saw with Main Street Capital. That combination of monthly base income plus occasional bonus payouts has made it a favorite among income-focused investors who want BDC-level yield without taking on the highest risk names on this list. The yield typically runs in the around 8 to 9%, and net investment income has generally covered the regular distribution comfortably. If Main Street Capital feels too conservative and Pennant Park Investment feels too aggressive, Capital Southwest often sits in a reasonable middle ground worth researching further. Invest $30,000 in CSWC at roughly a 8.5% yield, and you're looking at approximately $212 landing in your account every single month. Stock number 10, Oxford Square Capital, ticker OXSQ. And we close out the BDC section with genuinely the most extreme yield on this entire list. Oxford Square Capital invests primarily in collateralized loan obligation equity, often shortened to CLO equity, along with some senior secured debt. If that sounds complex for a beginner video, that's because it is, and that complexity is exactly the point of covering it last in this section. CLO equity sits at the bottom of a complicated, layered debt structure, meaning it can generate genuinely substantial cash income when credit conditions are healthy, but it's also cyclical and highly sensitive to defaults, loan prices, and financing costs in a way that's much harder for a beginner to evaluate than a straightforward business loan. The yield here has run close to 30%, the single highest figure on this entire list. Let me be completely direct. A yield anywhere near that level is not found money the market somehow overlooked. It's the market pricing in a meaningfully elevated chance that the payout gets reduced. This is an advanced, speculative holding, not a beginner's core income position. I'm including it because you'll see it on every highest yield list, and you deserve to understand why that number is so large before you're tempted by it alone. Invest $4,000 in OXSQ at roughly a 29% yield, and you're looking at approximately $97 landing in your account every single month. Stock number 11, Realty Income, ticker O. Realty Income has literally trademarked the nickname the monthly dividend company, and once you understand its track record, you'll see why. It has made well over 600 consecutive monthly dividend payments and has increased that payout well over 100 times since going public in 1994, more than 30 consecutive years of dividend growth. The business model is genuinely simple and durable. Realty Income owns thousands of single-tenant commercial properties, pharmacies, dollar stores, convenience stores, gyms, leased out under long-term, triple-net contracts, meaning the tenant covers property taxes, insurance, and maintenance, not realty income. That structure produces remarkably predictable, low-drama cash flow. The yield typically sits in the around 5 to 6%, notably lower than everything we just covered in the BDC section. And that's exactly the trade-off worth understanding. Realty Income isn't here for the highest number on the list. It's here because it's arguably the single most reliable monthly dividend payer that exists. The name most beginners should genuinely understand first before venturing into anything higher yielding. Invest $50,000 in O at roughly a 5.5% yield, and you're looking at approximately $229 landing in your account every single month. Stock number 12, Agree Realty, ticker ADC. Agree Realty is a net lease REIT similar in structure to Realty Income, focused on retail properties leased to investment-grade tenants. Think major national retailers with strong credit ratings, not small local businesses that might struggle in a downturn. That tenant quality focus is deliberate and central to the company's whole strategy. Agree Realty switched from a quarterly to a monthly dividend schedule specifically to appeal to income-focused investors, a genuine sign of how much this space has grown in popularity. The yield typically runs in the low to around 5 to 6%, similar to Realty Income, reflecting the market's confidence in a similarly conservative, high-quality tenant base. For a beginner, Agree Realty is essentially a slightly smaller, similarly disciplined alternative to Realty Income, worth knowing as a second option in the same conservative category, not a meaningfully different risk profile. Invest $40,000 in ADC at roughly a 5.5% yield, and you're looking at approximately $183 landing in your account every single month. Stock number 13, EPR Properties, ticker EPR. EPR Properties takes a genuinely different approach than the retail-focused REITs we just covered. It specializes in experiential real estate, movie theaters, entertainment venues, ski resorts, and attractions. Properties built around experiences people actively choose to spend money on, rather than just everyday retail. This niche made EPR one of the hardest-hit REITs during pandemic-era shutdowns, since experiential venues were disproportionately affected by capacity restrictions. The company did cut its dividend during that period, before eventually restoring monthly payments as its tenants recovered. A real, recent example of exactly the kind of disruption that even an established monthly payer can face. The current yield typically runs in the around 8 to 9%, reflecting both the recovery and the market's awareness that this niche carries genuine concentration risk tied to consumer discretionary spending and specific tenant health, particularly in movie theater chains. Invest $15,000 in EPR at roughly a 8.5% yield, and you're looking at approximately $106 landing in your account every single month. Stock number 14, Four Corners Property Trust, ticker FCPT. Four Corners Property Trust specializes in acquiring and leasing restaurant and retail properties with a portfolio spanning well over 1,000 properties across dozens of states. It was actually spun off from Darden Restaurants, the parent company of Olive Garden, giving it deep roots and expertise specifically in restaurant real estate. The company focuses on net lease structures with a diversified mix of restaurant brands as tenants, spreading risk across many different chains and cuisine categories rather than depending heavily on any single restaurant concept. That diversification is a meaningful part of its risk management approach. The yield typically sits in the around 5 to 6%, in line with other conservative, high-quality net lease REITs on this list. This is a solid, if less famous, example of the same disciplined net lease model that's made names like Realty Income and Agree Realty popular with income investors. Invest $35,000 in FCPT at roughly a 5.5% yield, and you're looking at approximately $160 landing in your account every single month. Stock number 15, Phillips Edison & Co., ticker PECO. Phillips Edison focuses specifically on grocery-anchored neighborhood shopping centers, the kind of everyday retail built around a grocery store, plus surrounding tenants like pharmacies, restaurants, and service businesses that benefit from that consistent foot traffic. This is a genuinely resilient niche within retail real estate, since grocery shopping remains one of the retail categories least disrupted by e-commerce. The company owns hundreds of these centers across dozens of states, and as a REIT, it's legally required to distribute the large majority of its taxable income to shareholders, which naturally pushes toward a relatively higher payout ratio and yield compared to a typical non-REIT company. The yield here typically runs in the around 5 to 6%. For a beginner specifically, grocery-anchored retail is often considered one of the more intuitively understandable and defensible real estate niches. Everyone understands why a shopping center anchored by a grocery store tends to stay full of tenants and foot traffic. Invest $45,000 in PECO at roughly a 5.5% yield, and you're looking at approximately $206 landing in your account every single month. Stock number 16, LTC Properties, ticker LTC. LTC Properties focuses on healthcare real estate specifically, senior housing communities, and skilled nursing facilities, leased to operators who run the actual day-to-day care operations, while LTC owns the underlying real estate. This ties the company's fortunes closely to demographic trends around an aging population, a genuinely long-term secular tailwind. The healthcare real estate niche does carry its own specific risks worth understanding. Operator financial health matters enormously, since if a nursing facility operator struggles financially, that directly threatens LTC's rental income from that property, regardless of how good the underlying real estate itself is. The yield typically runs in the mid to around 8 to 9%. LTC has paid monthly dividends for a very long stretch, making it one of the more established names specifically within the healthcare REIT niche, though it's genuinely smaller and less diversified than giants like Realty Income. Invest $20,000 in LTC at roughly an 8.5% yield, and you're looking at approximately $142 landing in your account every single month. Stock number 17, Apple Hospitality REIT, ticker APL. Apple Hospitality REIT owns a large portfolio of upscale, select-service hotels, primarily well-known branded properties like Hilton and Marriott flags, operated by third parties while Apple Hospitality owns the real estate itself. This puts it in a meaningfully different category than the other REITs we've covered so far, since hotel revenue is genuinely tied to travel demand and can swing with the broader economy far more than a long-term lease shopping center. Hotel REITs were hit especially hard during pandemic-era travel restrictions, illustrating just how economically sensitive this niche can be compared to something like grocery-anchored retail. The company has since recovered alongside the broader travel industry's rebound. The yield typically runs in the around 5 to 6%. Worth understanding as a beginner, hotel REITs generally carry more cyclical, economy-sensitive risk than the net lease and grocery-anchored REITs covered earlier in this section, a genuinely different flavor of real estate risk. Invest $60,000 in APL at roughly a 5.5% yield, and you're looking at approximately $275 landing in your account every single month. Stock number 18. Whitestone REIT, ticker WSR. Whitestone REIT owns and operates community-centered retail properties, primarily in fast-growing Sunbelt markets like Texas and Arizona, shopping centers anchored by everyday service businesses like restaurants, medical offices, and personal services rather than large national retail chains. This is a meaningfully smaller company than most other names on this list, which brings both an opportunity and a real risk worth naming directly. Smaller REITs can offer more growth potential as they expand, but they also typically carry less diversification and can be more volatile than a giant like Realty Income with thousands of properties spread nationally. The yield typically runs in the around 5 to 6%. Whitestone is a reasonable example of a smaller cap monthly REIT for a beginner to understand the trade-off between size and stability. Bigger isn't always better, but smaller does generally mean more concentrated risk. Invest $25,000 in WSR at roughly a 5.5% yield, and you're looking at approximately $115 landing in your account every single month. Stock number 19. Gladstone Commercial, ticker GOD. Gladstone Commercial is the real estate arm of the Gladstone family of funds we covered earlier in the BDC section. A genuinely useful thing to notice, since it shows the same management group operating across different asset classes under a shared monthly dividend philosophy. This REIT focuses on single-tenant and anchored multi-tenant industrial and office properties. The company has been actively repositioning its portfolio toward industrial properties and away from office space in recent years. A strategic shift reflecting the broader market's general caution around office real estate given ongoing shifts in how companies use office space. That repositioning has generally been received as a smart, forward-looking move by analysts covering the stock. The yield typically runs in the around 8 to 9%, somewhat higher than the more conservative net lease names covered earlier, reflecting both its office exposure and its smaller overall size compared to giants like Realty Income. Invest $18,000 in good at roughly a 8.5% yield, and you're looking at approximately $128 landing in your account every single month. Stock number 20. Health Peak Properties, ticker DOC. Health Peak Properties is a large, diversified healthcare REIT with a portfolio spanning medical office buildings, life science facilities, and senior housing communities. Its scale and diversification across multiple healthcare real estate niches sets it apart from more narrowly focused names like LTC Properties covered earlier. The company has been active in strategic joint ventures and portfolio optimization moves aimed at improving its overall asset quality and growth profile, and its yield has moderated somewhat from prior levels as the stock price has recovered, which is worth remembering. A falling yield can actually be a good sign if it's happening because the stock price is rising on improving fundamentals rather than because the dividend itself is shrinking. The yield typically runs in the around 5 to 6%. HealthPeak rounds out our REIT section as a large, diversified way to gain healthcare real estate exposure, sitting at a different point on the risk spectrum than the smaller, more specialized LTC properties. Before we get into the final 5, a quick, important explainer, because this category confuses almost everyone new to it. Mortgage REITs, often called MREITs, don't own physical buildings at all. They own mortgages and mortgage-backed securities, essentially borrowing money cheaply and using it to buy higher-yielding mortgage assets, profiting from the spread between the two. That structure means mortgage REITs are exceptionally sensitive to interest rate changes and are, generally speaking, the highest risk, highest yield category on this entire list. Invest $55,000 in DOC at roughly a 5.5% yield, and you're looking at approximately $252 landing in your account every single month. Stock number 21. AGNC Investment Corp., ticker AGNC. AGNC Investment Corp. is one of the largest and most well-known mortgage REITs, investing primarily in agency mortgage-backed securities, meaning securities backed by government-sponsored entities, which carries essentially no credit default risk, but still carries very real interest rate risk and leverage risk, since AGNC uses significant borrowed money to amplify its returns. The yield here typically runs into the over 10%, among the highest of any well-known, widely held name on this entire list, and mortgage REITs like AGNC are also well known for periodically cutting their dividends when interest rate conditions shift unfavorably, a pattern that's played out multiple times across this company's history. For a beginner, AGNC can be a genuinely reasonable way to access mortgage REIT exposures, specifically because it focuses on agency securities rather than riskier non-agency debt. But the double-digit yield reflects real volatility in both share price and dividend reliability, not a risk-free bonus. Invest $20,000 in AGNC at roughly a 14% yield, and you're looking at approximately $233 landing in your account every single month. Stock number 22, Dynex Capital, ticker DX. Dynex Capital is a smaller mortgage REIT that also focuses primarily on agency mortgage-backed securities, similar in structure to AGNC, using leverage to amplify returns from the spread between its borrowing costs and the yield on its mortgage holdings. Dynex has developed a reputation for somewhat more active, tactical portfolio management compared to some of its larger peers, adjusting its positioning more frequently in response to interest rate expectations, a strategy that can work well when management correctly anticipates rate moves and can hurt when it doesn't. The yield typically runs into around 10 to 11%. As with AGNC, this is a name where the interest rate environment genuinely drives most of what happens to both the share price and the dividend over any given stretch. Understanding the direction of interest rates matters more here than almost anywhere else on this list. Invest $30,000 in DX at roughly a 10.5% yield, and you're looking at approximately $262 landing in your account every single month. Stock number 23, Orchid Island Capital, ticker ORC. Orchid Island Capital is another agency mortgage-backed securities REIT, generally smaller and more narrowly focused than AGNC or Dynex, which tends to make it more volatile in both directions, share price and dividend, as interest rate conditions shift. The yield here has historically run among the highest of the agency mortgage REITs, frequently well into the over 10%, and Orchid Island has a track record of dividend adjustments, both cuts and, at times, increases, that closely track the shifting interest rate and mortgage spread environment far more tightly than any REIT or BDC we've covered so far in this video. This is a genuinely advanced, actively traded holding, not a passive income name for a true beginner's core portfolio. If you're drawn to it, treat it as a small position you're actively willing to monitor, not a buy-and-forget monthly check. Invest $10,000 in ORC at roughly a 14% yield, and you're looking at approximately $117 landing in your account every single month. Stock number 24, Invesco Mortgage Capital, ticker IVR. Invesco Mortgage Capital rounds out our agency and non-agency mortgage REIT names, investing across both agency mortgage-backed securities and some higher-risk non-agency credit investments, adding an additional layer of risk beyond what pure agency-focused peers like AGNC carry. The yield here has run notably high, often near or above the highest figures we've seen across this entire mortgage REIT section, and Invesco Mortgage Capital's dividend history includes real, meaningful volatility, including periods of significant cuts during stressed market conditions, a pattern common across much of this mortgage REIT category during periods of interest rate shock. For a complete beginner, this is exactly the kind of name that illustrates why highest yield and best income stock are not the same question. The yield is genuinely available to you if you buy the stock. Whether it's genuinely sustainable is a completely separate question that requires real, ongoing attention. Invest $7,000 in IVR at roughly a 16% yield, and you're looking at approximately $93 landing in your account every single month. Stock number 25, MSC Income Fund, ticker MSIF. And we close with MSC Income Fund, a business development company externally managed by an affiliate of Main Street Capital, the same conservative, well-regarded manager behind the very first name on this list. That management pedigree matters, since it means MSC Income Fund benefits from Main Street's established underwriting discipline and deal sourcing network, even though it trades as its own separate entity. MSC Income Fund lends primarily to private equity-backed lower middle market companies, often co-investing alongside Main Street Capital itself in the same underlying deals, combining recurring interest income with some selective equity upside participation. The yield typically runs in the around 8 to 11%. Ending on this name feels appropriate. It brings us back to the same trusted management philosophy we opened with. A useful reminder that across all 25 of these names, who's actually managing your money matters just as much as the yield printed on the screen. 25 monthly dividend payers, 3 completely different business models. BDCs lend to businesses banks won't touch. REITs collect rent from real estate. Mortgage REITs profit from the spread on borrowed money. Each category carries a genuinely different risk profile, and within each category, we saw real range, from Main Street Capital's disciplined single-digit yield all the way to OXSQ Capital's nearly 30%. Here's the single most important lesson from this entire video, worth repeating clearly. Yield and safety move in opposite directions almost every single time. The highest numbers on this list aren't secrets the market missed, they're the market's honest pricing of real, elevated risk. For a genuine beginner, names like Realty Income, Main Street Capital, and Agree Realty are far more reasonable starting points than chasing the biggest number on the page. If this breakdown helped you understand monthly dividend investing, let me know in the comments which of these 25 you'd actually research further, and whether you're drawn toward the safer end of this list or the higher yield end. I read every single comment, and it genuinely shapes what we cover next. And if you want more breakdowns like this, subscribe, because we're just getting started. One more time, because with a list like this, it matters most. This isn't financial advice, so always do your own research or talk to a professional before you invest a single dollar. Invest $25,000 in MSIF at roughly a 9.5% yield, and you're looking at approximately $198 landing in your account every single month.